market, and yet they are still among the top performers globally, right? So that tells you something about how much policy support and liquidity were doing the heavy lifting. So in my session today, I'll go through what's been keeping the markets afloat so far, things like liquidity, policy measures, and domestic demand shift. And I'll also talk about how this new tariff shock might change the story going forward. Then I'll pass it over to Sam. Sam will look at what all this means for investors across rate, currencies, and more. All right. And on the screen right now, next page, please. You can see the pigeonhole. The next one. Yeah. So please send your questions or upvote the questions already there. We'll cover them if time permits. All right. So let's get started. Let's turn to the first slide, please. So one question I keep getting over the past few months is, if the Chinese economy is not doing so great, then why were stocks doing so well, at least until now? Because if we look at the chart, CSI 300, for instance, was up about 30% from April, right? Basically defying gravity. And of course, what happened this week remind us how quickly things can turn when confidence take a hit. So the thing is, in the short term, it's not always about fundamentals. What really drives the market up or down is liquidity and sentiment. Let's talk about liquidity first. Think back to some of China's big market rallies in the past, like the 6,000 points in 2007 or the 5,000 points in 2015. In both cases, fundamentals were actually weakening, right? The market trend and economic fundamentals were actually diverging. But there was just so much cash in the system. So if you recall, in 2015, onshore investors were borrowing through different type of investment products, trust products, leveraging their buying power, piling into stocks, and that flood of money sent market soaring, right? Valuations way ahead of the real economy. So the main takeaway here is, in the short term, the market is not always about fundamentals. Liquidity and sentiment often take the lead. Yeah. So to be fair, even with the ongoing trade tension and the soft economic backdrop, there have been bright spots always. For instance, the new consumption sector, the tech sector, and the pharma sector, for instance, right? Liquidity been rotating across these sectors because there's like ample liquidity, ample cash, right? So I mean, policy, of course, play a very important role, right? It's been a big part of that story. If you recall, since late last year, the Chinese government's been doing a lot to keep money floating. Yeah. So, for instance, commercial banks onshore can now lend to corporate shareholders for share buybacks. There's a share buyback program. And since the beginning of this year, insurers have more freedom to invest in equities. So all of this help fuel the stock rally because these are very important structural liquidity. Okay. Then next slide, please. Then of course there is the PBOC, because we have been seeing interest rate cuts, we have been seeing a triple out reduction, as well as the open market operations on the right chart here. The gray bar above zero means liquidity injection. So all of that has pumped a lot of cash into the market. So that's why on next slide, you can see the result. Money supply, especially M1, it has been growing, it has been picking up very, very notably, right? Over the past like 6 months or so. So we have been saying this, we have been showing this chart because this is a very interesting development. M1 is a very important leading indicator of stock market performance. So if you put the red line, the M1, together with the Shanghai Composite Index together in one chart, you can see their correlation is very, very high actually, right? So it's a very useful indicator, and it is still right now rising. So it means the stock market probably still has legs. all right? And it's not just about money, of course. Sentiment, just like what I've mentioned, sentiments played a huge role as well. Since the beginning of this year, there was a lot of buzz around DeepSeek, right? Huge AI breakthrough. And then there are a lot of companies, including CATL, doing IPO in Hong Kong. So all of this lifted confidence and brought in a lot of foreign inflows. Next slide, please. So as you can see on the left chart, you may see foreign investors have been increasing Chinese exposure, including both equity and debt, over the past few months, right? So those inflow has actually strengthened the Chinese yuan as well, the renminbi. So that's why we are seeing the renminbi has appreciated from 7.3 to 7.1 today. So right now, with the potential 100% tariff shock, that optimism has cooled a bit, for sure. But the underlying drivers like policy support and domestic innovation are still there. And on that note, the Chinese governments have been doubling down on tech self-reliance. For instance, the tech giants like Huawei and Alibaba, both of them have rolled out their own chip designs. So it showed progress on the homegrown innovation front. So all of this helped, all of this really fired up investors, right? And there's a lot more. For instance, the anti-involution campaign, what it does is that it tries to curb excessive competition and stabilize pricing. And the logic behind that is if it works, it will help corporate profits and keep the market on a healthier footing over time. So all of these policies help, all right? So yes, it may be true that the mood today is not so great, it's not perfect, and volatility is probably here to stay for a while, but the broader picture hasn't totally changed, right? Liquidity is still there, policy is still very supportive, and some sectors are still showing strength. So the real question now is how policymakers respond to these renewed trade tensions, all right? And whether they can steady sentiment and keep liquidity flowing, okay? That is the key going forward. So for the past 10 minutes or so, I have been talking about how this market rally has really been fueled by liquidity and policy expectations, right? But that also brings us to a very important question, like what about the actual economic fundamentals, the real economy? Because frankly, they're still looking pretty soft. Next slide, please. So for instance, the worldwide growth, the year-on-year growth in total social financing actually slowed down to 8.8% in September from 9% the month before. So that's the first time it's decelerated since November. And as you can see on the left chart here, the big picture hasn't really changed so far. The government is still the main one doing all the heavy lifting with financing, right? The gold line is government bond, government financing, and total social financing without government financing is the orange line. So you can see household and companies just are not as eager to borrow money, right? The right chart also shows corporate and household borrowing have been shrinking over the past few months. So this really highlights why direct government spending is still very super important right now. All right. And of course, weak corporate lending has translated into weak investment. Moving on to the next slide, we can take a look of the latest development of FAI, the fixed asset investment. Just like what I've mentioned, weak corporate lending has translated into weak investment. The growth in FAI slowed to sluggish 0.5% in September. So that's the lowest since 2020. All right. And obviously property investment is still the main drag. All right. This number is the August number, sorry. 0.5% is the August number, is the latest available. All right. Property investment is still the main drag, obviously. And you can see on the right chart here, national property sales been dropping in the past 5 months. And if we look at the most updated numbers, sales during the National Day holiday were quite weak, dropping by more than 30% year on year. So if you recall, earlier this year, there were some sort of purchase relaxations, right, in tier one cities like Beijing and Shenzhen and Shanghai. That gave the market a boost, but the momentum right now is sort of fading. So you can see the red line here is sort of slowing down, is sort of falling, right? And in most other like tier two cities, the market is still pretty quiet. Home buyers are largely staying on the sidelines. So, but it's no surprise. We have been talking about this. We've been saying this for a while. High inventory right now in the mainland China is still the main issue. And many of those who wanted to buy have already done so. So that's why that explains. And on top of that, the labor market recovery remains sort of lackluster. So the sector still needs more time to regain momentum, that is for sure. And moving on to the next slide, let's take a look of the consumption sector. Retail sales actually were not that bad in the first half of this year, but that was mainly driven by government subsidies and programs like the trade-in initiative, right? But right now, local governments have mostly used up the subsidies, and most buyers have already made their purchases, households or corporates, they have already made their purchases, right? And you will not buy another mobile phone again in 3 months, right? So if the central government were to renew the subsidy program, say after the upcoming Platinum meeting, that would be great. That would certainly help. But the real issue is that the overall spending still lacks real momentum. The labor market recovery is still sort of subdued, just like what I've mentioned, right? People are still not easy to get a job, even in big cities like Beijing and Shanghai. And this year we have more than 12 million university graduates, and finding a job for them is a real uphill battle. So that's why we are seeing, the recovery, sort of the momentum is falling after the trading programs fade. Moving on to next slide, as far as the external sector is concerned, exports were doing well in the first half. Actually, it's really well in the first half, but mainly because of front loading. Companies rushing to ship out goods early before any new tariffs hit. So that drove a lot of, exports, right? But again, that momentum is sort of fading right now. Shipping costs, as you can see on the right-hand side, have started to come down, and that usually means shipments are going to slow. All right, and with the additional potential tariffs coming into play, the outlooks right now is getting cloudier. But the good news is that demand from other regions, especially Europe and Southeast Asia, should help cushion the blow, because trade data released yesterday was not bad, right? Export in September rose by more than 8%, mostly due to non-US shipments. So if we look at the detail, year to date, China exports to the US were down about more than 30% year on year, but exports to the rest of the world were actually up more than 10%. So that's why overall exports still managed to grow, which shows China's done a pretty good job maintaining its non-US markets. Okay, so overall, we are probably not looking at a sharp drop in exports. Okay, and it's not just one way. We're also seeing a rebound in exports to China from other economies as well. And our chief economist, Tamer Beck, actually did a deep dive on this in this week's weekly report. So do check it out if you're interested. And before I hand it over to Sam, let me spend a few minutes on Hong Kong as well. So Hong Kong stock market has been on fire this year. The HSI, the Hang Seng Index, is up by more than 26% year to date, even after the correction over the past 2 days. All right, it is still one of the best performer in the world. even beating the S&P and the Nikkei. All right, IPO activity has been heating up. We have seen some big names, including CATL, which was the largest listing globally this year. And if I remember correctly, more than 60 companies raised around 23 billion on the US dollar, all right, on the Hong Kong Stock Exchange in the first 9 months. So putting the city comfortably ahead of the New York Stock Exchange and NASDAQ. And because Hong Kong is an international financial center, right? The financial sector really matters here in Hong Kong. So, I mean, if you look at the chart on the right, it makes up about a quarter of Hong Kong's GDP. So when the market is doing well, the positive vibes tend to spread quickly across the city. It lifted related industries like law firms, insurance, asset management, and some other professional services. And we also see that momentum flowing into consumption as well. Next slide, please. So as you can see on this slide on the left, retail sales rose by 3.8% year on year in August. So that was 4 straight months of growth. We have also seen more visitors coming in since summer. That helped offset some of the spending Hong Kongers are doing across the border in places like Shenzhen and Zhuhai, right? And if we go back to the left chart, what really stood out were those tourist favorite categories like jewelry, watches, and luxury gifts, right? That category climbed by more than 16%, which is encouraging. That is good news because luxury spending has actually been pretty soft for some time. So it will be very, very interesting to see if this recovery can last. And then if we look at the red line, which is medicines, cosmetics, it grew by 5%. And so that is also good news as well. But it's not all good news, of course. There are some items which are not included in this chart. For instance, some categories more tied to local spending are still under pressure. The sales of fuel, for instance, dropped by more than 10%. Probably because more people right now in Hong Kong are filling up in Shenzhen, right? And furniture, food, and supermarket items also slip a bit. And the drop means, aside from cross-border spending, it also shows the retailers in Hong Kong are sort of cutting prices to stay competitive with the mainland, all right? Yeah, so now let's turn to property market in Hong Kong. Next slide, please. Transactions picked up quite noticeably through 2024 after the government scrapped some property taxes, as you can see on the left chart here, right? And now with the lower borrowing cost, prices also seem to be stabilizing finally after falling almost by 30% from the 2021 peak. So looking ahead, there is probably room for further rate cuts, which Sam will talk more about later. That's good news. That's good news to the property market in Hong Kong. But because inventories are still high, as you can see on the right-hand side here, so most of the developers in Hong Kong are likely to stay cautious on pricing. So for the full year, our property team is expecting home prices to be roughly flat. And as far as the office market is concerned, next slide, please. Things, again, are also starting to look up recently. In August, for instance, leasing activity rose for the 5th month in a row, and rents fell about 2.5% in the first half of this year. But the pace of decline has slowed significantly compared to the previous years. So we can take that as a sign that the market might finally be stabilizing. And we've also seen some big leasing deals recently, some mainland law firms, some US private equity firms and insurers are taking new space. some of them even leasing the entire floors of some buildings. So there's definitely more movement in the market right now. But having said that, because there is still so much new supply to the market, the absorption rate is still low compared to historical average. So that's why we are still expecting vacancy rate will probably stay high for a few more years before trending back to the pre 2009 levels. All right. So in a nutshell, the directions is improving with no doubt, which is great development, but it may take a bit longer before rents really picked up because of the high inventory, because of the new substantial supply. All right. So that wraps up my part on the latest in China and Hong Kong. I'll now pass it over to Sam. Sam, all yours.
Thank you, Nathan. Thank you for a wonderful presentation on China, Hong Kong macroeconomics and recent stock market performance. And for the next session, I will go through the implication on rates, FX, or the wider asset market. So again, if you have any questions, please feel free to put it into the pigeonhole, and then we'll try to answer questions accordingly after my presentation during the Q&A section. So first of all, for China, we are looking at a lower long end rates and probably a flattening curve could return. So for now, if we look at the chart on the left hand side here, we can see the red line, the 2-year CGB yield, the government bond yield, is relatively steady. And then, but then for the 10-year government bond yield, it has rose all the way up to like 1.9%, and then it fell a little bit back to 1.85 as of today. So we can see that the curve have been steepening quite sharply if you look at a chart in the middle here, but there is some room for flattening again. Because of a couple of things. First of all, we are looking at a weak economic fundamental, just as Nathan has mentioned. The China borrowing is still quite weak, so there are a lot of excess liquidity. If they are not flowing into the equity market, they will flow to the bond market, and that will keep the long end yield relatively low. And not to mention for the short end is still quite low because of the ongoing easing. And then if you look at the rest of the macroeconomics, or let's say the inflation, which I will go through in the next slide, the inflation is still weak as well. So that is prompting the CGB yield curve to a flattening one, moving into a medium to long term. So, but of course, there will be some more, government spending or some stimulus policy, perhaps next year, and that we will have the planner meeting very soon, and we are also looking at some fiscal stimulus. But but given the inflation is still quite weak, then a flattening curve could be in place. So if you look at a chart on the right hand side here, let's say for the 10-year government bond yield breakdown by policy rates expectation, term premium, and liquidity, we can see that over the compared to the past 3 months, the 10-year treasury yield has been moving up, and that was mainly driven by the term premium, where a lot of our investors are expecting more fiscal spending moving forward. But we are already coming to the end of this year, so most of the government bonds issuance has been done. So perhaps we are now waiting for next year and see if there is more fiscal spending moving forward. So as I've mentioned, China is now undergoing a period of overcapacity, and that is driving the inflation quite weak. So if you look at the chart in the middle here, you can see the CPI is quite weak at like negative 0.4, and then the PPI is negative 2.9. But core inflation has been picking up back to 0.9%, which is a positive signal. But I mean, for headline CPI and PPI, they are all contracting. So that is suggesting the corporate profit is still quite weak. So if you look at the chart on the right-hand side here, you can also see the overall headline industrial profit is steady around zero comparing to last year. But then for SOE, which is the state-owned enterprises and occupied quite a big amount of the investment or loan growth of the economy, you can see it is the industrial profit of the public sector is still quite weak. So with that in mind, we can come up with a conclusion that which is we have an overcapacity problem. We are supplying more than what we need. So what is the driver behind this weak inflation? It is the the tariff, which is the external uncertainty. So let's say if we take a look at the automobile sector as an example, if you look at the chart on the left-hand side here, you can see the fixed asset investment of the automobile sector is growing much faster than the retail sales and exports of the automobile at like 20% for fixed asset investment. So that means we are investing or we are producing more than what we are selling domestically or externally. So that is driving the inflation downward. But as Nathan has mentioned, we also have some more domestic policy to support the economy. Perhaps there will be more, stimulus on, subsidies or other policy that drive the domestic consumption. But that will take time. So in the near term, the inflation is likely to remain relatively weak, and that will drive the long end yield lower moving forward. So for now, we are looking at the 10-year CGBU. We're looking at it at 1.6% by the end of this year, comparing to the current level of 1.85%. So that means there is another 25 bips room of downside moving forward in the next 3 months. So another thing that we are why we are looking at a relatively lower long end yield is that the government bond supply is relatively is relatively limited, because according to the budget earlier this year, Chinese government is expanding the fiscal stimulus by 2% of GDP. So 1% is from the deficit ratio. The other 1% is from the local government and the central government bond supply. But most of them have already been used up. So if you look at the table here, we can see that the net issuance quota, only like 15% is left for CGB, and only 11.9% is left for local government. So from a supply demand perspective on for the Chinese government bonds, it looks like the supply for this year is mostly used up. So that is another reason why for the fourth quarter we are looking at a lower CGBU for the longer end. And then the other thing is I've mentioned there is a liquidity driven upside for both equity and bond market, right? So first of all, if you are looking at the bond investment as a percentage of total asset allocation for banks, so let's say chart on the left-hand side here, you can see the medium to small banks, big four banks, or financial institutions, their bond investment as a percentage of their total asset allocation has been rising sharply over the past 2-3 years. And that is one of the reasons is that the weak fundamental is driving these excess liquidity into the asset market, including the bond market. And that's the reason why the Chinese government bond yield has been falling from like 2-3% down to 1.8% now, and we continue to see some room for downside. And the other thing is there is a rotation between bonds and equities from an investment perspective. So if you look at the chart in the middle here, you can see there was, over the past 3 months, the asset market of China has been categorized by a strong inflow into equities. The red bar has been outpacing the orange bar, equities outpacing the bond inflow. So if you look at the chart on the right-hand side here, usually when the equity is doing well, bond yield increase because the demand for renminbi from asset market is increasing, and also because the investor, if they have they are parking their liquidity in equities and therefore less so in bond. So right now it's the other way around. A lot of our investors may take profit from the recent the recent peak because of the trade tension is re-escalating. So now they are looking for some safer asset, which is the Chinese government bond. And if the rotation is continue, then the 10-year government bond yield may fall moving forward. And then for the Chinese government bond, of course, we are not just looking at the the central government. We are also looking at the local government bond as well. So if you if you look at the chart on the left-hand side here, you can see the 10-year central government and local government bond yield. They generally move together because they are the same sort of same asset class. But the spread has been rising recently over the past 2-3 months because there is some concern over the local government bond or the LGFVs, whether the local government can repay their debt. As Nathan has mentioned in his presentation, the land sales has been quite weak in China. Property sales has been quite weak, and land sales is one of the big, components of the local government revenue. So if the land sales is continue to fall given the weak property market sentiment, that means the local government fiscal health is being challenged. And that's the reason why investors are quite worried about whether the local government will go default or not. But in fact, if we look at the default rate of local government bonds, it's still relatively low. And then if you look at the chart on the right-hand side here, the local government debt has been rising. The LGFV local government bond and debt as a percentage of GDP has been rising all the way from like 58% in 2018 to 88% in the first 8 months of this year. It looks quite worrying, but in fact, if we take the whole country together, the government debt as a percentage of GDP is not so worrisome because the central government debt only account for like 26% of the China GDP. So taking the local government and central government debt together, the total government debt or public debt as a percentage of GDP is still around 100%, which is still lower than the overall G20 average or the overall DM market. So if we look at the central government itself, again, it's only account for 26% of the GDP for its debt. This comparing to 200% for Japan or 150% for UK. So it's just still relatively low. So that means the local government can seek the help from the central government to swap the debt. So the central government can issue more and take on more fiscal stimulus responsibility, or even swap the debt from local government back onto the central government book. So if that is the case, then the local government debt situation is not that worrisome. So if we look at the spread between the local government bond and CGB yield again, perhaps we'll start to ease on entering the fourth quarter again. And the other thing is that the PBOC is going to cut the interest rate, right? So more rate cut and more easing from through the open market operation, through repo or outright repo or MLF, then all this kind of liquidity will help keep the overall liquidity situation eased, and that will drive the local government bond yield lower or tighten the spread again as well. And the other thing that I want to mention for China rate is the offshore rate. For the offshore rate, it's usually move along with the onshore rate as well, but with a spread to reflect the liquidity situation in Hong Kong. So, but then the spread between the onshore and offshore rate is going to compress or stay steady moving forward because the liquidity situation here offshore is still quite abundant. So if you look at the chart on the left-hand side here, for the CNH forward implied yields, 1 month, 3 month, or 6 month, they has been quite steady, keeping anchored because the renminbi exchange rate is still quite quite strong. So if you look at the chart here, the CNH exchange rate is still at around like 7.1 to 7.15, and that prompts the PBOC to stay hold on, issuing more bonds offshore to tighten the liquidity situation, so as to strengthen the exchange rate. So if you look at the chart in the middle here, you can see if the exchange rate is strong, then the PBOC perhaps will issue less bond. Let's say during the 2019 or 2021, when exchange rate is strengthened towards 6.5 or even 6.36, then the central government is issuing less CNH bills in Hong Kong. And then when the exchange rate is weakening on entering 2022 till now, then you can see the PBOC is issuing more. So in that case, if the CNH exchange rate is still steady at around like 7.1 to 7.13, which our FX strategist is expecting it to strengthen even towards 7, then the overall PBOC CNH bill issuance in Hong Kong should remain at base. So if you look at the chart in the middle here again, you can see the CNH bill issuance this year is largely on par with last year, and the exchange rate is also largely not on par, but it actually is even strengthened over the past year. So with that in mind, we expect less bill issuance moving forward. And then if you look at the chart on the right-hand side here, the market is also expecting a strengthening CNH exchange rate. So if you look at the 12-month forward, which is the orange line for the chart on the right-hand side here, you can see it is even below 7. That means the market is also expecting the renminbi to strengthen even to below 7 against the US dollar. So with taking all these together, the CNH rates offshore should largely follow the trend of onshore, and also the spread compared to the onshore market should stay steady as well. And there's another thing that I would like to mention for the offshore rates from the policy perspective. So recently, the China and Hong Kong Central Bank, which is the PBOC and the HKMA, has already enhancing the CNH liquidity situation in Hong Kong through opening up the onshore repo markets. So for offshore investors who are already in the onshore market, they can tap onto the onshore repo and take the liquidity out from onshore to their offshore market. So if with this is being effective very soon, then the offshore liquidity will be increased, and that will continue to drive the onshore and offshore spread tighter moving forward. And then the Hong Kong dollar rate, so we are also looking at a receive opportunities on lower US dollar rate. Because the Hong Kong dollar rate and US dollar rate is usually moving alongside with each other, except a small episode during the it's May to September this year. So if you look at the chart on the left-hand side here, you can see usually the orange line and the red line and black line, they are moving towards alongside each other, which is the Fed fund rate, 3-month and 1-month HIBOR. But during the second quarter or the third quarter of this year, the US dollar was weakened. And then this allowed a lot of liquidity to flow into Hong Kong because the HKMA has been selling the Hong Kong dollar into the system when HKD is hitting the strong side of the convertibility band against the US dollar at 7.75. So the aggregate balance once jumped from like 44 billion to 174 billion. And then after the US dollar normalized, let's say the DXY is already back to 98 or 99 recently, then the Hong Kong dollar weakened towards the 7.85 of, which is the weak side of the trading band. Then the HKM may buy Hong Kong dollar and extract liquidity from the market. And you can see the aggregate balance, which is the gray area, fell all the way back from like 174 billion back to 54 billion. So that's the reason why the HIBOR returned to like 3.4, 3.5% recently. So, I mean, because of the fixed of the Hong Kong dollar peg, then it is not so easy for Hong Kong dollar to deviate from the US dollar trend too much over the longer time span. So with that in mind, with the Fed is going to cut the interest rate by another 50 bips this year and another 25 bips next year, we should continue to see some receive opportunity for the Hong Kong dollar rate. So if you look at the chart in the middle here, the 3-month HIBOR SOFR spread is around like 37 bips as of now. And then the usual spread between HIBOR and FFR or HIBOR and SOFR is around 80 to 100 bips during a preemptive rate cut cycle. So that means right now the Hong Kong dollar is too strong or the HIBOR is too high. So why is that? It is because over the past 2-3 weeks, it was the quarter end and a lot of the corporates are rushing for liquidity to settle their payment or settle their debt. And there was a week-long holiday in China. So there are a lot of, loan demand from onshore, to settle their payment before the holiday starts. So now with the holiday already come to the end, then the liquidity conditions should start to ease again. And the silver bond is another thing that kept the the HIBOR a little bit higher than what we usually see over the past 2-3 weeks. But after the the subscription is gone, then we should see the liquidity condition in Hong Kong start to ease again. So that's why we are looking at a receive opportunity for Hong Kong dollar rate. And the other question is, so which tenor we should look at, which is the shorter tenor. Because if you look at the chart on the right hand side here, you can see the 3-month forward and the spot curve of the Hong Kong dollar IRS. So the red line is the spot curve, the dotted line is the forward curve. So you can see from 3 months all the way to 4 or 5 year tenor, the Hong Kong dollar spot curve is much higher than the 3-month forward. So that means if our investor is looking at the receive opportunities, we should look at the shorter tenor, because for the longer tenor, it is less affected by the liquidity tightness recently, and it is reflecting the the US dollar movement instead. But for the shorter tenor, given the liquidity conditions should start to ease in the next couple of weeks, then there is a receive opportunities here. And then the other thing is that the HIBOR may enter a very volatile regime moving forward. I'm not saying it will keep fluctuating every single day. It's not the case, but perhaps we will see the it go back to like 0%, 0.5% or 1% this kind of level again if the US dollar is weakened again. Because I mean, for Hong Kong dollar rate, of course, it's pegged to the US dollar and it should follow the US dollar. But at the same time, the loan demand here in Hong Kong also play an important role on the Hong Kong dollar rates movement, because if the loan demand increase, then the banks may raise the interest rate for their customers, right? So if the loan demand is weak, that means the banks have to cut the deposit rate or they have to cut the loan rates. So in that sense, the HIBOR may be quite volatile if the US dollar weaken, and then the Hong Kong MA will start to come into the market and sell the Hong Kong dollar again. So if you look at the chart on the left hand side here, and in fact, the 12-month forward of the Hong Kong dollar exchange rate is still quite strong, even below the 7.75 of the strong side of the trading band. So that means if Hong Kong dollar started to strengthen, or if the US dollar started to weaken again, then it is likely the HKMA will step in and sell the Hong Kong dollar. So if that happens, Hong Kong dollar rate will fall. If you look at the chart in the middle here, it is a chart for 1-month HIBOR, FFR, and the loan to deposit ratio for Hong Kong dollar. So if you look at the orange line and the red line, you can see some sort of pattern here. The Hong Kong dollar loan to deposit ratio and the 1-month HIBOR, actually they move quite, simultaneously, except the QE period during this 2010 to 2016 when the Fed fund rate and HIBOR was 0. So for the other normalized interest rate time, that the loan to deposit ratio actually move alongside the HIBOR. So that means if the if the loan to deposit ratio started to rise, but only at a steady pace, HIBOR should not be priced at a too high. So that's the reason why we should keep our eye on the US dollar exchange rate and then see if that would trigger some sort of intervention of the HKMA and add downward pressure on the HIBOR. The other thing is not just the domestic loan demand, is also because of the external loan demand, especially those from China. So if you look at the chart on the right hand side here, you can see HIBOR has been at around 3.4, 3.5%, which is higher than the 1-month SHIBOR. So the upshot here is that for onshore loan demand, they may not come to offshore. For onshore borrower, they may not come to offshore to borrow the Hong Kong dollar like what we see, before the COVID time when the China rate is higher than the Hong Kong rate. So if that is the case moving forward, that means the loan demand will be still quite weak for Hong Kong, and that will, become a risk for HIBOR to fall moving forward. And then here is my last slide on Hong Kong dollar rates before we move on to the Q&A section. So again, this is to explain why the domestic demand is still weak and why the loan demand from China is still weak. So if you look at the chart in the left-hand side here, you can see the local use loan is at 1.6%. The growth is at 1.6. And then if you look at the total loan is only at 0.8%. So that means the overall loan demand in Hong Kong is steady. It has been improving, but it is not a V-shaped recovery. And then if you look at the foreign use loan, it's actually declined by 0.9% year on year. So that means the demand from mainland China or from the rest of the world on Hong Kong dollar loan is still quite weak. So if you look at the chart on the right-hand side here, this is the China loan and deposit growth. As mentioned by Nathan just now, the credit demand in China is still weak, and the loan growth is only at 6.8% year on year as of August. So that is driving the loan demand on Hong Kong lower as well. I mean, even the onshore loan demand is weak. And then the Hong Kong dollar rate is higher than the onshore renminbi rate. Then if you were the borrowers, you may prefer to borrow onshore even if you have a loan demand. So that is one of the key risks on the Hong Kong dollar rate. And then the other thing is the local loan. If you look at the unemployment rate in Hong Kong, which is one of the major indicators that we look at for Hong Kong economic situation, it is rising at 3.7%, which is some sort of a relatively high level for Hong Kong because Hong Kong market is usually very tight. We fall short of labor supply, so a 3.7% is considered a relatively high unemployment rate. But of course, moving on to 2026, the strong asset market, steady renminbi exchange rate, and front-loading activities from China, and also increasing export from China to the rest of the world outside US. These are all setting up the stage for Hong Kong economy to recover. Perhaps the unemployment rate will start to fall on entering the fourth quarter or maybe earlier next year. Then the loan demand will start to improve on entering perhaps on entering 2026. But in any case, the loan demand from China is still weak. That is driving the overall HIBOR downward if the US dollar weaken again. So that's it for me on Hong Kong dollar rates, and then we can move on to the Q&A section. So again, if you have any question, please feel free to put it into the pigeonhole here, and then we will try to answer your question. Thank you.
All right, thank you, Sam, for the detailed breakdown on rate. Really appreciate it. So let's take a look. Let's take a look at the questions we have on the pigeonhole. One of the questions that we've got here is China's referendum is coming. What are the key areas to watch in the 15 5-year plan? Well, investors should keep a close eye on a few big areas. Obviously, one of them is the tech development. The tech development is going to be a huge focus. Things like advanced semiconductors, AI, biotech, aerospace, China will really push for self-reliance here. Then there is the demographic challenge. The Chinese government will very, very likely roll out policies around aging, around healthcare, childcare, which could create opportunities in related sectors as well. Then green energy is another key area, for instance, with ambitious targets for renewables and clean tech, because we are talking about the next 5-year plan, which includes 2026 to 2030, right? Carbon peaking is one of the goals by 2030, okay? And finally, building resilient supply chains for food and critical resources is likely to get a lot of attention as well. So sectors supporting that could see growth too, right? So yeah, that's my take about. Let's see if there's one of them is, will the government set GDP target for the next 5 years? I'm assuming you're talking about China, right? So yes, the answer is yes. I think the government will set a GDP target for the 15 5-year plan. They usually do. They have been doing it, except during the 14th 5-year plan because of the pandemic, because of COVID. But given the current economic backdrop, for sure, it's very important for Beijing to signal commitment. It's very important for Beijing to give markets and businesses some clarity. And don't forget, the bottom line is that China is still aiming to double per capita GDP by 2035, which means it needs to keep growth at just over 4.5% a year to stay on track. All right. The next question we have is this. Both Sam and I will take this. The GDP report coming out next week will likely show that the economy weakened further in Q3. Do you think the PBOC will cut rate right after that? My answer is probably not. The timing is a bit tricky right now. There is still a chance that President Donald Trump and President Xi Jinping meeting will happen in Korea. So the PBOC will likely hold off until that plays out. Right now, there's a lot of politics in this, all right? And plenty of debate in the market. For instance, what China did with the rare earth export control is probably meant to put a bit of more pressure on Donald Trump ahead of the APEC meeting. And obviously, Donald Trump doesn't want to look weak, and hence this 100% tariff plan. So it's really more about posturing before negotiations, right? And there are many different views right now in the market, such as, has China overplayed its hand with those export controls? Or is Donald Trump's move actually playing into Beijing's hand? Honestly, there is no clear answer to that yet. But one thing we can say is there is still hope, because the new tariffs, the potential new tariffs, will not kick in right away. They are set to take effect on November 1st. That means 2 days after Trump's scheduled meeting with Xi Jinping, right? So that timing kind of suggests Donald Trump's leaving the door open for a possible deal. Okay, but if that meeting doesn't go well, and the 100% tariff actually goes through, that would hit China's economy hard, and that might be the moment when the PBOC stepped in with a rate cut. All right, Sam, you have anything to add? You're mute.
Sorry, I just muted. So I think for the timing for the rate cut, perhaps will be in the in November or December, like what Nathan has just mentioned. Aside from the waiting for the the discussion between President Xi Jinping and President Donald Trump, there's another thing is that the recent stock market has been quite. It has been performing quite well, right? So that is also keeping the PBOC from cutting interest rate too fast, and also the bond yield has been too low at around, as we mentioned, is at around 1.85 for 10-year and then 1.4 for 2-year government bond yields. If there is sharp cut or accelerated pace of rate cuts, then bond yield may fall even faster, and a lower rate will also impact the bank's net interest margin, the NIM. So if that is the case, I think the PBOC may refrain from cutting rates too soon, perhaps in November or December instead of right after this week. Another thing I want to mention is for the China and U.S. trade tension. As Nathan had mentioned, there is 100% tariff on China. Just here, I have a bit of supplement. According to our estimation, the impact of 100% tariff on GDP, on China GDP growth, will be 0.66 percentage point for 2025, given the 100% tariff will only be effective for 2 months, if there is one. And then for 2026, the impact would be at around 1.5 to 1.6 percentage point. But this is the direct impact. There is a lot of stimulus policy from the monetary side and also fiscal stimulus to help offset such demand. So we are not too worried about the reaching the 5% target of GDP growth for China this year, and next year we're looking at 4.5% growth.
All right, thank you very much, Sam. That brings us to the end of our live stream. A big thank you to everyone who joined us, and we hope to see you again next month. Bye-bye.
Thank you. Bye-bye.